Hello, this is Fred Hopkins from Mountaintop Loan Services. Just wanted to give you a little bit more tips on how you can finance your investment properties. Now, I was wondering if you've heard about all the bad press about cash flow arms, pay option arms, smart loans, and all the different names that they call loans with negative amortization. Now, a lot of it is warranted, but one thing that we have to realize is with pay option arms, it's a loan tool, and just like any other tool, there's a right way to use it and the wrong way. Now, most people that get pay option arms do it just to get a lower payment on the house that they live in, mainly because they couldn't afford it any other way. They finance the house to the hilt, 95% or 100% financing, and then when they try to sell the house, they find out that they're upside down, especially as the balance starts to increase over time. Now, pay option arms are a good choice when your home is seeing good appreciation, 5% or more, because the loan has the ability for negative amortization, which means that the balance will actually increase over time. Now, in that case where your appreciation is pretty robust, the appreciation rate will easily outpace any increase of the loan balance. Now, pay option arms are also good if you're financing properties that are under 90% of the value of the property. In fast appreciation markets, you can get away with higher amounts, but leaving at least 10% equity in a house is a bare minimum. Well, why would you want to do this? Is mainly because if you try to sell the house through traditional means, your selling costs could be anywhere between 9 and 15% of the sales price. And I don't know about you, but I don't like the idea of having to come out of my pockets just to sell a house. I want to make money when I sell a house. So, and particularly with real estate investors, investors can find some of the biggest benefits of using pay option arms when they take some of the criteria that I mentioned before. Using pay option arms will afford you the ability to have flexible payments. Now, which most pay option arms you get four payment options, thus the name pay option arm. The first option is to have a payment based upon the introductory rate, which sometimes can be as low as 1.75% and even lower than that. The second option is for interest only, where you just paying the interest that's accruing on the loan. The third option is a 30-year amortization, which is the loan payment based upon spreading the payments evenly over 30 years, and same thing with a 15-year amortization. Now, what that also allows you to do is maximize your cash flow, and in essence, especially if you're making that minimum payments, you can double or more the cash flow on a property. So it allows you some flexibility to do some other things, such as minimizing the effects of vacancies. If you have a lower mortgage payment that you're going to deal with, well, in essence, you have lower carrying costs. So if you do have a month of vacancy, it takes a little bit of the bite of the way of someone not paying you money to be in a property. Now, also, it helps you to put a little reserve by if you need to save for those always unexpected repairs that come up. I've owned a lot of investment property, and there seems to be always something that goes wrong, and having a little extra money to take care of those is always a good thing to have. Another thing that comes along with that is you can be a little bit creative here and give some incentives to your tenants. Sometimes you can give them extra credit for paying before the first of the month. Like, for example, if you tell them that you're going to give them a $25 break on the rent if they can make their payment by the 25th of the previous month. Give them discounts on longer term leases, 18 to 24 month leases, so on and so forth. You can also use that extra cash flow to pay off personal bills. If you got an extra $200 a month cash flow coming in, one of the obvious things that you can do is pay out some credit cards, pay off your car a lot quicker, etc. And one of the most important or most powerful ways that you can leverage using a pay option arm is buying additional property. Now, if you've had one property that you've doubled your cash flow on, if you're able to pick up a few more like that, you can find yourself very quickly in a situation where you have thousands of dollars a month in cash flow because of the type of financing that you have on a property. So those are just some basic things I wanted to go over here with pay option arms. Hopefully that will kind of get your brain going about how you can finance them, and looking against some of the more traditional ways of doing so, especially if you have a little shorter time horizon with how long you're going to hold on to a property. So that is it for now. Hope this was informative for you. And if you have any further questions, be sure to check us out at mountaintopmtg.net, and you can go to our investor loan page at investorloans.htm. Again, this is Fred Hopkins from Mountaintop Loan Services, and happy investing.